As you can see, we have three numbers here. Any idea what they represent? No. Okay, which one?
The right below.
Yes, this is related to dividends. Well, you will know at the end of the presentation very well what they represent.
Yearly.
No. I mean, it could be actually, yes, but it's not. Before starting, just out of curiosity, how many of you have invested in REITs before, or they know what REITs are? Can you? Okay, only. So all the others, they have no idea what are REITs. Good. So just to give you a short overview, when you invest in real estate, in properties, you need a lot of capital. It's not easy, right? So REIT is an alternative. You can still invest in the real estate market through REITs, where you don't need a lot of capital, and you have many advantages that I will show you later. So basically, REITs is a way to access the real estate market. And here we are speaking about Singapore, okay? Now, the first number is the number of REITs listed in the Singapore Stock Exchange. Because REITs are not like physical properties, they are companies, okay? So they are listed in the stock exchange. It means you can buy and sell shares of REITs. And why is it good news that we have 40? Because 40 is not a big number. Can you imagine if you have to analyze like the thousands of stocks in the US market? But here you have not even 40, so you can save time. It's not a long list, right? 100. This is the minimum number of shares that you have to buy when you invest or trade in the Singapore market. Now, the range of price for REITs is usually, well, not zero, but something about 0 to less than $3. Less than $3 means that already with $300 you can access the real estate market. Which property can you buy with $300? Nothing. You need thousands or millions, right? So this is already a very good advantage. And as someone said, yes, this is the best income you can get with dividends from REITs. That is also higher from what you can get with physical properties. Okay? Now, before starting, I have to show you the disclaimer, because I'm not a financial advisor. Everything I say is not a suggestion to buy or sell anything. Okay? So I can share with you something. If you lose money, it's your fault. If you make money, I was good. Okay? Now, this is the outline of the presentation. The first part is the basics of REITs. So what is a REIT, how they work, and the types of REITs, because we have different types. Secondly is the analysis. How can we choose out of these less than 40 REITs the right ones? And we will see something related to the fundamentals of the REIT, so how strong is the company behind, and the technicals, meaning the sentiment of the people about the particular company. And then we have the practice. That's why I asked you to install some software and to bring your laptop. If you have not done, it's okay, we will do it here. But I share with you a slide, a checklist that you can use to evaluate a REIT. Okay? By the way, I may ask you to complete some of the sentences that I start during the presentation, so please do it, because you learn better when you participate actively. Now, let's start from the basics. So what is a REIT? As I said, it is a company listed in the market, but it's different from the normal companies. You see, the normal companies, they take the money from the investor to improve the business, usually, right? To grow and REITs, no, they use the money of the investor for what? To buy and manage properties. That's what they do. They take money from investors and also from banks, and with this money, they buy and manage properties. That's the difference from a normal company. Why they do that? Actually, no. Why is it good for us that they do that? Because at least 90% of the rental they get from the properties they are managing is given to us as investors as dividends. And this money in Singapore is tax-free. So it's good. You get dividends, passive, and tax-free. And what is the advantage of REITs compared to real estate, the normal properties? Okay, first is more liquid. Imagine you have a house worth millions of dollars, and then you need the money immediately, and you want to sell. Maybe you don't find immediately someone willing to buy at the price you want. maybe you have to wait months, right? But since REITs are listed in the stock exchange, it's much easier to find someone willing to buy your shares. I mean, provided that you want to buy it at a reasonable price. Then it's more diversified. When you buy a property, it's one property, that's all. But when you buy a REIT is basically a company managing a portfolio of properties. And they can be Singapore and overseas, and they can be of different types, so it's more diversified. Then you need less capital, we have seen already that. And taxes are lower, actually no taxes on dividends. So what is the structure of the REIT? Well, here on the left you see the investors like you and I. You invest in a REIT, so you give money, you buy the shares. And a REIT also can get money from the bank. Okay? What do they do with this money? Well, there is the main objective is to buy properties. Okay? And after that, of course, there is a management that is managing the REIT, and they charge some fees. And there is a trustee, someone checking that everything is done in the interest of the unit holder, or at least we hope. Now, types of REITs. There are 5 types of REITs. How many?
5.
Okay, thank you. Retail REITs. What is retail? Retail is basically malls. Here, I don't know if you can see, but that is JQ in Jurong East. Then we have industrial, hospitality. That doesn't mean hospital. Okay, hospitality is hotel, it's not hospital. Hospital is that type, healthcare. Okay, and finally office. So let's have a look at these 5 types of REITs. Retail. Well, retail, they focus basically on shopping malls, mainly. And some examples are Capital Mall, is that guy owning the JQ, and SPH. SPH, if you don't know, is the company owning the Clementi Mall. Okay? Industrial. What about industrial? Well, the focus here is different, is warehouses and business parks. And these are a few examples. Ascenda Street, that by the way, I think is the largest in terms of market cap in Singapore, and Maple Tree Industrial Park. Then we have hospitality. As I said, it's hotels, not hospitals. And a few examples are Ascot and Ascenda's H stores. Office, or sometimes they are called commercial. Here the focus is office buildings, of course. And again, a few examples, Suntec or Capital Commercial Trust. And finally, healthcare. The focus is hospitals, not only, but mainly. And, well, examples, actually there are only 2 in Singapore. First REIT and Parkway Life REIT. Now, healthcare and retail are somehow more defensive. Okay, because even if there is, let's say, a recession, people still go to the hospital, right? And also for retail, it's very, like the switching cost for people to move a shop from a mall to another one is a little harder than, for example, moving your office to some other building, right? If there are many empty buildings. So this is something also to consider. Okay, what about, yes?
Why there are no REITs like condominiums or private houses? Or?
Actually, there was one REIT, residential, it was called Sizen REIT, but it was delisted. He was the only one, and he was investing in properties in Japan. And eventually, he was delisted. But maybe in Singapore is not something popular, I don't know. But these are the only 5, yes. So of course, there are also some, actually it's only this 5, yeah. It depends if they invest only in Singapore or overseas, of course. I will not touch much about that here because we only have 1 hour, but something that you may check is also if the REIT you are buying, even though it's listed in the Singapore Stock Exchange, it is owning properties in Singapore or overseas. For example, there is one Fortune REIT listed here, but it's basically owning properties in Hong Kong. Okay, what about analysis? Well, there are 2 things we need to care. Number 1, what to buy, and this is the fundamental, and technical is when to buy or sell. Okay? Good. Now, there are 4 things that we touch here related to the fundamentals. How many? Okay. So the first one is the gearing ratio. What is that? It's basically the level of debt. I said at the beginning that a REIT is also taking money from the banks, right? Now, the ratio between the borrowing and the asset is called gearing ratio. And why do we care about that? Because if this is too high and interest rate increases, then what happens? That the REIT must pay more, right, in interest. So if this is too high, for the REIT it may be a problem to pay back. They may even have to sell properties to do that, and you can imagine that as a consequence the stock price will drop. So we don't want, and this is the criteria we use, less than 36. Some people say less than 40, but I'm a little more conservative. Less than 36, why? Because if it's too high and there is an increase of interest rate, we may have problems. Number 2, DPU. What is it? Distribution per unit. So it's basically the dividends that you get for each share that you own. It's the passive income. Is the way the REIT take the rental and give back to the investors. Okay? And for every share, the amount of money you get is called DPU. Why do we care? Well, because this is what tells us how profitable is our investment. And here, what is the criterion? Of course, we don't want a REIT that is paying less and less money. Why would you invest in someone that is giving less and less? You want some REIT where the distribution per unit is stable at least, or even better if it's increasing. Okay? Number 3, yield. What is that? Well, this is basically the annualized DPU, how much you get as dividend in 1 year over the share price. Is the 5 to 7% that was in the first slide. And basically, this is another way to quantify the distribution per unit that you get with a number. And it's relative to the share price. So you know that I pay this to buy the shares, I get this, is 5%, 6, 7, 8. This can make the difference when you choose one instead of another. What is the criterion here? Well, you would like to get at least 5.5%, in my opinion. Why? Because there are other ways to invest in REITs that give you maybe a little less than that. But if you do the effort to do the analysis of your own REIT, you should get something more. I will share with you later, there are ETF tracking REITs, but this is for later. Last one, price over NAV. Okay, what is the NAV, net asset value? Okay, so basically it's the value of the REIT for each share. And basically, when you compute this ratio, share price over NAV, is a way to understand if you are paying too much for the REIT or not. And actually, yes, it's telling you if the REIT is overvalued, fairly valued, or undervalued. And since here the focus is investing long-term, not trading, we want to buy something when it's not overvalued. Okay? And the criterion is 1, possibly less than 1. 1 is fair price. Okay? So you're basically paying for what you get. But this is not really safe to check because there are some REITs that never go to 1. For example, healthcare REIT, they are always above 1. So it's better to check these compared with the historical high and low to get a better idea about over or under value. Okay, because let's say you use this less than 1, you will never buy REITs in the healthcare sector, for example. Okay? So this was for the fundamentals. Now, how many of you know this? Are familiar with the candlestick? Okay. Okay, when you look at the chart, we are now in the technical part. The fundamental is done. When you look at the chart of the stock, you may have seen these things, right? Sometimes instead of green, they are white. What is the meaning of this Japanese candlestick? So the meaning is this. Let's say that this candle represents 1 day, okay? The low of the shadow is the lowest trading price for that day. And the high is the high of the shadow. And this is the same for the green or the red one. So what is the difference between these two? Is the body. So the green one, this is the open price, and this is the close price. What does it mean? That that day, the market opened here and closed above. So the price went up. So it's called bullish candle. On the other hand, the red one, what is the meaning? Well, the price opened here, but closes here. It means that that day, the price went up. And that is called bearish candle. So you need to be familiar with this because when you look at the chart, usually you have this. So you must be clear what is the difference between bullish and bearish candle. Okay? Now, usually there are three, these are the candles. Here we have white instead of green, but it's just a setting of your software. I don't want to share too much about technical analysis because, no, I don't think it's the time. But just a few simple things. When you look at the market, you may have three main types of patterns. You may have a consolidation, so the price is moving like that between two levels that are usually called support and resistance. Okay? And what happens is that sometimes when you have this situation, yeah, you see the market, the price is hitting here and then going back and so on. It doesn't mean that it will keep doing that. It's just that when you are in this phase, it's more likely that the price will move like that for a while. So this is called consolidation, and basically you have the same low and the same high. Then you have the trend, uptrend. So what is the thing here? You see that now support and resistance are not horizontal, and they are going up. So you have higher low and higher high. So of course this is really simplified, but it's just to give you an idea about the main concept. And finally, the opposite, the downtrend. So you have lower high and lower low. Okay, why is this important? Because would you invest in something like that? I mean, if your objective is to keep the stocks for a long time to collect dividends, this is a good situation. The price is stable, right? And you keep getting the dividends. By the way, this bad year is when they pay you the dividends. So you keep holding your share and you get your passive income. When it's going up, even better. You even have capital gain. In case you want to sell later, on top of the dividends, you also can make money because the price is going up. But in this situation, unless you have a really clear indication that the price is bouncing back, it would be risky to buy when the trend is going up.
So for REITs, you cannot go short, or like you cannot bet on the
Okay,
price increase.
you can go short, but it will be trades. And remember, there is the risk. The thing is, when you go short, you pay the dividends. If you are shorting a REIT and there is dividend, right, the day when they pay, you have to pay. You have to pay to the person who gave you the share to short. So for short-term trading, you can do it. But let's say you own the share here and you are shorting, then you have to pay dividends. But this is something more advanced, so I will not touch this yet. We can maybe discuss later about that. Okay, so what can you do to build a strong portfolio? So first you have to find good REITs. And then we have seen the 4 criteria, right? Gearing ratio is the level of debt they have with the bank. Yield and DPU. So DPU is how much you get as dividend per share. The yield is the percentage, right? Annualized DPU over price. And the price over NAV that is telling you if the REIT is over, under, or fairly valued. Then we look at the technicals. No, sorry, we look later. We want to buy, we have seen we have 5 categories, right? So maybe if you want to diversify, it's good to have a look at the best in each category. You don't want to buy all your REITs in the retail sector. Because if then the sector is doing bad, all of your REITs will go down. I mean, it's more likely that they will go down together. And then, when do you sell a REIT? Well, there are two reasons in my opinion. Number one is because you see that the fundamentals are not good anymore. These things that we check here, they are not so good anymore. So you may sell because something's wrong. Or you may sell if for some reason the price is going up so much that by selling at that moment, you will make the money that you would make with dividends in maybe 2-3 years. So maybe better to sell and buy back later if the price is dropping. Okay? Now, you may say, okay, it's too complex, I don't want to spend time, I'm lazy, right? What do you do? Well, there is another alternative. It's called REITs ETF. Are you familiar with ETF? Exchange Traded Fund? No. Basically, ETF is, again, something that you can buy and sell in the stock market. And when you buy a share of an ETF, you are buying basically a share that is divided in a lot of REITs. So this ETF buy a basket of REITs, and by investing in the ETF, you are basically investing in a basket of REITs. And what is the advantage? Well, diversification, but also starting July 2018, even ETF, what you get, the gain you get is tax-free. Before it was not. Now it's tax-free. And there are three so far in the Singapore market, the Philips, the Lion, and the Nikos. But what is the problem? That the yield you get is maybe less than this 5-6%. That's why I was saying, if your REIT that you choose is not giving you a yield that is better than this, maybe better just to go with the ETF. And a way to invest, if you are lazy, is called dollar cost averaging. Meaning, after every 3 months, 6 months, whatever, you invest the same quantity of money in that ETF. What does it mean? If the share price is going up, you buy less shares. If it's going down, you buy more. Right? Because you invest the same quantity, like $300 every 3 months. Whatever the price, I buy $300. Next 3 months, $300. Okay? And this is something that is possible to do if you don't want to do the technical analysis chart, you are confused. That's also a way. Okay, any questions so far? No. So it means it was either very clear, or you have one. Yes. Okay, that's a good question. The sign can be so you have technical analysis. The sign could be some, for example, you see a strong bullish candle, right? There are some, you know, the Japanese, they like to give strange names to all these things like one white soldier, arami, and what. You can find online there are a lot of strange combination of candlesticks that indicate a reversal. But I can share with you more. I mean, I don't have it here in this presentation, but there are some combination of candles, like maybe a red one and a white one higher or something like that, that can tell you that, yeah, maybe the price is starting to bounce back.
So this 5 to 7% dividend you showed at the beginning, that's like depending on the share price of the REIT, right?
Yeah.
So the share price varies over time.
Yes.
What does it depend upon then? Because that's the big question, right? If
You mean what is the reason why the share price is
increases or goes down, yeah. Because that's the big question.
Okay, the thing is this. Usually after dividends, you have a drop in shares. Because, okay, you know, it would be easy to say, I just buy before they pay the dividend and I sell after that, right? Right, well, it's not so easy. Usually, at that moment, you have a drop in price. So it's already, like the dividends is already taken into account in the share price.
Oh.
If you have a bad news, you can have a drop, of course. But in general, it's the sentiment. Let's say that the overall sentiment is bearish, people are not, or maybe the sector is not doing well. Maybe the office sector is not doing well, and then you may have prices going down. So from a fundamental point of view, it may be related to less income, occupancy rate, it can be dropping. You know, maybe you have offices that they cannot find people to.
So it's related to the rental price of the office? Or
It can be one reason, but it can be also the sentiment. There are many reasons. I mean, if you know the answer, tell me, because, I mean, analysts can come out with a lot of ideas, but yeah, it's not clear, right? It may be fundamental reason, it may be technical reason, it may be like the sentiment, or it may be that the economy is bad, people are, or maybe, you know, some big investors are moving money in the rotation of sectors, so it can be many things. But we are not trying to predict what will happen. We are just following some rules that we defined before and avoiding dangerous situations. Okay? So do you want to have a 5 minutes break or no? Okay. Now, practice. The reason why I organize this workshop is easy. I want to share with you 3 tools that you can use to screen and check information about REITs. You don't need to pay anything. That's a good news. You have only 40 and you have 3 tools. So for screening, we need to find all these criteria, 36% and that. We have this. You should have received an email, and I say that you may create an account. It's free. If you have not done, no problem. We will go through this. But this is one example. For Singapore, I don't know for US market, but for Singapore, this application is fine. For charting, I suggest Chart Nexus, and when you install, you can select a market, and in the email I say choose the Singapore market, and this will be with 3 years of data free. That's why I think it's quite good. And I say that we should check the historical price over NAV, because just saying above 1 overvalue, below 1 undervalue is not really the best. Where can we find that? Partially on the first one, but there is also a website that we'll show you later where you can find this chart updated every month. Okay? So I think we can go to the practice session where I will show you these 3 tools. Okay? I want to start with, this is the screener. Do you have this? I mean, if you have your laptop, you can access. But basically, what is this? This is the list of REITs, names. This is the ticker if you want to check the chart online. You can use this code. This is the sector, okay? And here they tell you the share price, the yield, gearing, price over NAV. This is related to the historical price over NAV. Market cap is basically the number of shares times the price. And if the market cap is big, usually it's more stable. And this is quite interesting. If you click here, you will find different information about the REIT. And the most important in our case is P. Instead of having to go through every quarter report to check how much they pay as dividend, you click here and you have a chart already done for free. So I want to show you, for example, if you click here, what happens. You will see from 2008, this is how much they pay as dividend. And you have this information here for free. And I want to show you one case that to me is very interesting. Is the Savannah. Okay, if you go online and you check this REIT, you know what you see. You see a chart that is going up like that. And then you check here and it's going down. Why? Because you know what they did. When they prepared the report, instead of showing the dividends they pay every time, they just show the sum, they call the cumulative dividend. So what you see here is whatever they pay so far plus the new one. So of course it's increasing. But it's just to, I mean, I will not say cheat. It's like a different way to represent information. So if you're not careful, you think it's good, but actually it's not. And this, by the way, is something that you don't want to invest in this guy. Why? Because you see they are paying less and less and less.
And it's to the beginning only, so way less than 5.
Sorry?
At the beginning, it was also way below your threshold, right? Another number.
No, this is the dividends they pay. There is no threshold for that. It's just checking if it's stable or increasing. That's the dividend paid out. Okay, so what should we what can we do this here? First, we can screen. For example, let's say we want only those where the yield is 5.5. You can check on your laptop if you write here 5.5. Okay. You only have those from 5.5. You want the gearing less than 36, you write here 36, and it's already screened out. 1 second. If you have to do this manually, going through the record of every single one, it will be a pain. And these data are changing, by the way. So you do it today, in 1 month maybe you have to redo. But if you do it like that, it's very easy. So here we have already checked 2 of the conditions, right? And then we have to check the dividends. For some new REITs, of course, they don't have enough data, but I would avoid to invest in very new REITs because you don't have history, you don't know how old they are. And if you want an indication about the historical price over NAV, is this. If you look here, they say that this is based on the price over NAV for the last year. So you want to invest in something rated A or B, maybe not D. Now, I want to show you something else that you can use to check the historical price over NAV. That if you look at your checklist is the condition number, the 2.D. So this one can be used for the 2.A, 2.B, and 2.C. Okay? If you look at your checklist. The 2.B, the DPU, you click on B. Okay, and you check the chart. Price over NAV, you can go to this website, mystockinvesting.com. It's on my website, but what is interesting here is that if you click on REITs, and here, Singapore REITs range chart, you see, then you get this nice chart, right? And then you can see the current price over NAV, and this bar represents the range, low, high. I think it's 1 year. So, for example, you want to buy something, you want to buy this. No, because it's very overvalued, right? So this gives you an idea like this, maybe, okay, I can consider this. This is already starting to be overvalued. Also this one is very low, undervalued. So this gives you an idea about the real valuation. And if you look at the healthcare section, as I say, you see that it's never below 1. The rate is always above 1. So that's why I don't feel that looking at the absolute number 1 as a reference is really a good idea. Okay? And finally, we have the charting software, right? This one. So here you can see, if you log in, your candles, and if you point here on the back, they tell you the dividends that were paid. But of course you don't have to look at all this because you will be already in the website. And you can create watch list. I have one with REITs, but just to show you the Savannah that I showed you before, right? You see what's happening here? This is the one where the DPU was. And it went down a lot. Now it seems it's kind of consolidating, but already we will not invest in these because the dividends they are paying was going up. So now what I suggest for the last 10 minutes, we can take a REIT and go through this list, okay? So we can together check and see how you can use this for analyzing a REIT. Of course, it's a simplified, as I said, the disclaimer, don't do this, okay, they buy that, lose money, the company, no. But that's at least to give you an indication and possibly avoid those like these that maybe you don't want to touch. I mean, I hope there is nobody holding Savannah REIT here. Okay, good. Just to check. So what can we do? Let's take, for example, let me see. And by the way, this one, capital retail China, okay? Okay, 7.28 yield, quite good. Is less than 36, okay? Let's check the dividend. I would say it's quite stable. I mean, there may be some small dip, it's fine, but just the overall trend should be stable or going. So, what can we do? We can fill this form. I will do it as well. So, the name of the REIT is, we can check here, right, is Capital Retail China.